Worrisome global growth numbers. Will this cause the S&P to begin another slide down? I will go over this in the weekly review of the markets for week ending March 22nd, 2019. This is Agustin Hernandez. Before we begin, the opinions voiced in this material are for general information only. All performance reference is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. Technical analysis is the forecasting of future financial price movements based on the examination of past price movements and cannot predict the future. Technical charts referenced are subjective. No strategy can ensure success or protect against loss. International markets involve special risks such as currency fluctuation and political instability. These risks are often heightened for investments in emerging markets. International investing may not be suitable for all investors. Investing involves risk, including loss of principal. Sector investing will be subject to greater volatility than investing more broadly across many sectors and companies. On this week's agenda, there were some concerning economic growth numbers. How did that affect the S&P and its rally of 2019? How was the leading sector able to weather the sell-off on Friday? Should we be concerned about the banking industry? There is strength in the 10-year U.S. note. Another corrupt ex-president in Brazil arrested. How did that affect one of the few markets in a bullish pattern? And finally, what does this mean? There were some concerns regarding a slowing economy. First, FedEx announced disappointing earnings, but also warned that global trade is slowing down. That was followed later in the week with the European Union weak PMI numbers showing very low growth and worries of a recession. And finally on Friday, the yield curve inverted. Last time that happened was in 2007. But we are here for the charts and what the markets are telling us. So the S&P, despite a major sell-off on Friday, was able to keep its price above both its 200 and 50-day moving averages. That was good. The 50-day moving average line is still sloping higher, which is also positive as it will attempt to get above its longer-term moving average. Price and moving average indicator-wise, nothing as of now has changed. A recovery is still in progress. Below, we see the momentum indicator. The MACD did turn green briefly, but it turned orange on a big sell-off on Friday. Using daily charts, this is not uncommon. Choppy sessions in the markets can have that effect. Now, can the S&P take it on the chin and begin a new positive momentum charge and get back to a rally mode? We shall see in the next few days. As we go over the infotech sector, we see that nothing much has changed for this index. Looking at the box, we see price is in a tight trading range. It has been at or near its 200-day moving average, and it may be using that as a line of support. Now, it has been in this area for close to a month, so it may be getting close to making a move. Now, whether that move is up or down, we may have to look at momentum. As we see in the MACD, this index began gathering strength, and even with the sell-off on Friday, it was able to keep its bars green. If it can weather this pullback and stay green, we may see an upside positive breakout for this index. But if it turns negative, then that is not a good sign, as price may fall below its long-term moving average, and it will then have its 50-day line beginning to slope downwards. This is a major index to keep an eye on over the next 10 days. One sector of concern is banking. Here we see the S&P Bank Index. Here from the beginning of the chart, we see the 50-day moving average below its 200-day line. After the rally in late December and January, this index got into a tight price range. It tried to break out and get above its 200-day line and failed. With the 50-day moving average looking like it wants to begin to slope down, this index could be in for more drawdowns. Would also not be good for this sector to have both its moving averages falling while price is below them. Looking at its MACD indicator, we see the bars are back in orange, which means momentum is negative currently. This index has had a hard time keeping momentum positive for any period of time since February. For now, this index is not doing well. With all the fears of a global economic slowdown and the stock market fears Friday, the 10-year U.S. note finally was able to break above its old highs of 2019. As we see, price was in a tight range and began a slow process of getting past that 123.50 mark. It finally did, and with that rally, its quicker day 50-day line began to also slope higher. Now, if we look at the MACD indicator, we see green bars, which is positive for this index. How much further can this government note go? Though to me it is fascinating to see the birth of a possible bullish run of an asset, how much will its strength hurt the U.S. stock market? This will be interesting to see how the story plays out. We end the charts with a look at the Brazilian Bovespa. Now, this stock market had a rough week. On Thursday, a major sell-off took place as it was announced the arrest of former President Temer. It was another case of corruption as he joins another former president known as Lula. This shook the Bovespa exchange on Thursday, and the following day was a global stock sell-off. Now, how did this affect one of the few stock markets in a bullish pattern? Well, it did take a hit, but for now it looks like a pullback. In fact, this is not the first time price has fallen below its 50-day line. It has done it several times and it rallied stronger. Though it can be tough to see days like this, it is as now just volatility. With the sell-off on Thursday and Friday, we see momentum turn orange, which is negative. This has been a choppy rise for this index, but if it can pass its old recent high, this will just be seen as a blip on a bullish run. What does this mean? Despite what transpired on Friday and taking in the negative global news, nothing really changed. The S&P is still in recovery mode. Price was able to hold above its 200-day moving average, and the 50-day moving average is still marching towards a positive crossover. Should we be more concerned about what FedEx, the yield curve, and Europe had to say? Maybe, but for now the markets are, as of now, not too concerned. What is more concerning for stocks should be the strength of the 10-year U.S. note. As I have mentioned ad nauseum in these videos, the strength of the U.S. government note in the face of the 2019 stock counter rally was impressive, and when the market showed a sliver of weakness, this note was able to break out and pass its high of 2019. The S&P is close to a breakout into a bullish pattern, but they are not there just yet. A key may be the infotech sector. For now, it is resting on its 200-day moving average. If it can get a bit of positive momentum, it may lead the S&P into a bullish run. We are so close to getting an answer on whether this rally is over or just in a pause before heading up. Maybe in the next week or two, the charts will give us that answer. Until then, be cautious and patient. Thank you for viewing my video. Please like and subscribe to my channel for future videos. Also follow me on Twitter at my handle HRSNYC.